Welcome everyone, and g'day Andrew. Hard to believe it's December already.
Yeah, morning, Shane. Yeah, it's pretty frightening, isn't it? In the blink of an eye, the year's kind of gone, come and gone.
Indeed,
just about.
Indeed. And it's nice to be here again, of course, at the eve of Christmas, sharing monthly market and economic update. And as we talked about last month, a bit to talk about today again. Never seems to be a dull moment.
No, that's right.
In the investment land,
And particularly in the last week or so, we've had the updated inflation data for Australia, and then obviously what played out with the RBA yesterday.
Yeah, well, maybe let's talk a little bit about it in a moment, because there was, I think that's going to centre a fair chunk of our time today about RBA's announcement yesterday. But on the screen, we're sharing now the kind of the GDP growth, around the world. And has there really been any changes that you can sort of note here, Andrew? And I suppose this is something we're all watching with interest, with in relation to recessions and the like.
The only thing I am aware of I guess of note and of update is GDP for Australia is out today, I believe. I'm not sure what time that'll be out, but forecasts are 0.5 for the quarter and 1.9 for the year. So I guess relative to historical trends, that's obviously quite suppressed.
Yeah.
And probably in light of all the economic commentary, not surprising. So I guess what's going to be really important to see play out, particularly in the early part of next year, is whether that'll soften any further. As well, we keep commenting that the economic data has been quite resilient, but I'm not sure how much longer that'll be.
I think that's valid, and I think we're at that point now, right, where retail sales have been a little bit softer, which has been kind of interesting to watch through the course of the year. And I think on the back of Black Friday sales last week or so, I think we're going to see this little spike of retail spending, and then that's more than likely to kind of fall away, I suspect, after this little run through to Christmas. But yeah, these GDP numbers are interesting because, I mean, at the end of the day, the speculation about whether we have a recession or not still centre around GDP. And I agree. We've seen a lot of resilience in the market. But I think notably now as well, I mean, Europe is starting to sort of change narrative a fair bit in regards to their outlook. And it feels like there's been a kind of a significant reversal in discussion over there. But, as we sort of talk about here, domestically, we're still seeing that trend of GDP come down. And, you touched on a moment ago about the Reserve Bank and their meeting yesterday. The next time we see, the Reserve Bank meet will be in February, which will be right after the release of the December GDP numbers as well. So, they're going to have a fair chunk of data to assess where we're at from that point forward.
Yeah, and that came out in the release, didn't it? They said they wanted to wait and see and get some more data before they feel comfortable or confident making their next call.
Yeah, which is sensible, isn't it? I mean, often we're critical of the Reserve Bank because they move too quickly or, make decisions which we feel are kind of, off the cuff, but they're really not. And it'd be good to talk about in a few moments about some changes to the Reserve Bank next year as well. But, they certainly are taking their time now, and, a few people caught off guard with the rate rise in November on Melbourne Cup Day, of course. But, of course, yesterday seeing it sit tight for the time being. So maybe to sort of follow on from that, CPI and inflation is still kind of the biggest theme of the world, and I must say, digressing slightly from economics, it feels as though they keep telling us that CPI is coming down.
Yes.
But my grocery bill feels like it's still going up.
Yeah, well, I think it's that's right. CPI data is certainly trending down, which is pleasing to see. But it's in the context of everything else, and you feel we are feeling the pain in price points everywhere, aren't we?
Yeah.
So, and if you've got debt, obviously that's magnified in those situations.
Definitely. And what I think has been really interesting with CPI is that there is such a lag effect, and we've talked about it a few times in our monthly updates, of course, and the amount of time that rate rise takes to actually have an impact on the actual economy itself. And it's probably safe to say there's a runway of maybe 5 or 6 of the 13 rate rises we had in Australia that haven't even started to scratch the surface of the impact here. So, the fact that we're getting closer and the CPI is trending down, and from all reports, the current CPI is certainly perhaps speaking to the fact that we're seeing it getting, we're going to see it kind of drop off quite meaningfully in the short term. And I did note, sorry Andrew, I did note that in Europe overnight, the ECB spoke very specifically to inflation, and they've changed their narrative entirely almost about data's changed. Conditions are softer than they were forecasting, and they too now have started to shift their view that inflation is perhaps now under control.
Okay.
And the rate outlook has shifted slightly in regards to the next move being down with rates as compared to a lot of discussion had been recently about another rate rise.
Yeah, right. Well, I think even in the US, some of the commentary overnight might have been around with the softer job openings report, and now markets are potentially starting to forecast rate cuts over there as early as next year.
Interesting, isn't it? I mean, it's this whole dichotomy about wages and job openings. It still baffles me because theoretically it should be a good thing, right? That people have got jobs. But even to that point, Andrew as well, Australia have had the softest job opening since early 2021 as of now. So this there's certainly shifted, and we've just shared a screen now, a chart on screen in regards to wage price index growth, and I don't know. It's hard to tell whether that reversal is systemic just yet.
Yeah, and the other thing to comment on that is, although there's been a pretty strong growth in that over the last 3 to 4 years per the chart, that uptick in real terms because of the high inflation, it's household take-home pay in real terms is still down because inflation is a lot higher than those numbers.
Yeah, and it still seems as though it's stuck a little bit too, hasn't it? That it's fascinating. The sort of discussion's been about where inflation has been stuck is here in service wages in particular.
Yeah.
And until they see that reversal continue further and further, there's still been this kind of pressure about, are we done with rate rising just yet? And as you noted rightly before, the Reserve Bank are now taking all this data in and having a little look at it.
That's right.
So our interesting charts here, Australia's interest rates versus the world, and I think this is a good chart that we can perhaps pick apart in regards to where we see interest rates at this point in time.
Yeah, well, certainly the if my eyes serve me correctly, there the orange line on the left hand side, that chart there is the Australian cash rate, and clearly the forecast there is for that to hold flat for most of the current year. Looks like maybe one more rate increase is forecast in. And most of the other countries and central banks, the forecast for their actions is starting to come down and reduce rates in the second half. So that'll be an interesting watch to see what happens there, and clearly how that has a then correlation to the mortgage rates on the right-hand side, which have all, for obvious reasons, ticked up across the board.
I think it sort of speaks too as well to the structure of Australia and how our market is so linked to interest rates. You see there on the left-hand side that current cash rate and expected cash rate is lower than the world, but on the right-hand side we're sort of at the pointy end of the mortgage cycle. And we talked about it previously that the US are linked more to their 10-year rate rather than the short-term cash rate for mortgages. And so really what that means is Australia is certainly probably feels more of an impact when rates rise. And interesting to sort of draw a parallel there with New Zealand, because New Zealand's got a similar structure to Australia, and have been kind of very aggressive in their rate rising cycle previously, and certainly probably suffered a little bit ahead of Australia has economically. And their trend now is down with rates as a forecast. So, I think it's going to watch this space. I mean, the sort of combination of sort of weakening GDP, these sort of charts in regards to the impact of mortgage holders in Australia. I think it'd be fascinating to see where it lands next year. Yeah,
and the spin-off to this has been the housing affordability, and that's been at odds with the rate increases. So property has made a recovery. Property prices have made a recovery, but that's more on the supply side. And I saw something a couple of days ago that spoke to the average household or the average householders per residence, and that's playing a part. You've got immigration levels are starting to come back up, so there's clearly a shortage supply, and that's having more of an impact on the prices of property.
Yeah. It's that sort of supply side is fascinating, and demand is still seemingly there, right? So I mean, but at the end of the day, people have got to live, and we've got this issue with rental costs as well, and rental availability. Right. So people kind of haven't really got a simple solution either, right, in regards to moving out of mortgage land into rental land, or vice versa. It's still hard to get a place to live. So we're looking now in regards to sentiment, and I think one of the things about economics, I feel, Andrew, and probably be worth touching on now, is that it seems as though the headlines are always negative. There's not often you get an economist get on screen and talk about how amazing the world is. It's always, there's an issue here, there's an issue there, and it seems to kind of cause a little bit of fear and anxiety at times. But this chart here talks about Australian consumer confidence. So perhaps let's start with that, and then maybe let's expand a little bit in regard to how we're feeling about the world. Yeah,
well, clearly there's based on those the surveys and the results of those surveys, consumer sentiment is at an all-time high. An all-time low over recent history, as are the business surveys. Heard some commentary the other day. I don't know how real this is, but they spoke about sale of men's underwear, and when that can be potentially a lead indicator as bad times ahead.
People aren't buying new underwear.
Yeah, supposedly us mere males, we slow down our replacement of undies.
Yeah, right.
And that, if we're finding times can be tough. So some economists or some analysts has found a correlation between sale of men's underwear and economic times. So
interesting.
Anyway, we'll keep a watch on that. I haven't seen anything formally come out.
Check my drawer when I get home tonight and see how it looks.
Yeah.
Well, confidence is fascinating. I mean, I think at the moment the sentiment has been so low because when you get the world seemingly shifting underneath the feet that we're underneath the ground is shifting every single day, right?
Yeah.
And the thing that sort of I note at the moment is that you kind of look back 2 months ago and the world felt really unstable, and then we fast forward 2 months, and I think a few of those key indicators that we touched on today are starting to look a little bit healthier, dare I say it, and I say healthier in terms of there's more of a clearer pathway forward in that, like if rates, for example, stop raising, or at least we know forecast out confidently that the data is supporting a more clearer pathway as compared to the unknown. So we see some of these consumer confidence things start to tick up. Investors can start making decisions again in regards to, do I allocate my capital confidently when you can sort of see a pathway forward? Yeah. And I think sometimes it doesn't necessarily matter whether or not rates are actually higher or lower. It's more about knowing more so about where the rates are sitting.
Yeah. But you're spot on with the news and all the economic commentary. Any time you turn on the news, there's always doom and gloom and negativity around some of the key economic data, and it's almost like any sort of news is bad news at the moment.
Yeah, and interestingly, would you believe this? Last night, my wife came home from work after being in the car for an hour, and she listened to an economist on the way home, and she gave me a rundown on the state of play. I thought, oh, geez, if that's happening, then there must be some news out there that I need to get my head across. So, quite interesting.
Yeah.
But, household income and consumption, a chart that we sort of talked to a little bit, and that saving ratio, perhaps something we should pick apart here, Andrew.
Yeah, as we've spoken about previously, the savings have been taking a bit of a dive in recent times, and I guess the interpretation of that, Shane, is that that's people and households eating into their built-up savings as they've found things a bit harder with rising interest rates, rising inflation, and just finding it tougher to make ends meet and dipping into their savings.
Yeah, and I think that's a good call out because, I mean, that's the fear that the data is being kind of, the GDP data is being supported by factors that are historical, like people using their savings, like you say.
Yeah.
So, I feel like, and particularly again looking last night, Europe have got a similar, set of numbers to what we have, and you see overnight the ECB seeing data which now supports the fact that things are really kind of, about to reverse and they change the narrative. And I think it's, these savings actually speaks a fair bit to that. So, I think after Christmas it's going to be interesting to see where it all sits. And, but having said all that, the fact that we feel like we're getting closer to this inflationary position being under control, I think is cause for optimism as compared to alarm.
Well, so all that action that has been taken place, it has to hit home at some point. So I think we'll keep a close watch on that.
And we just thought we'd revisit this chart here again. We've talked about this chart probably for the last 6 months in this forum, and kind of looking at the that sort of doom and gloom scenario on the news that we see every day. From being a major recession type, environment versus, do we land at a really healthy place, or do we land somewhere in the middle, that sort of, volatility and seeing the news come through and markets reacting. I don't think anything's changed too much, Andrew, but do you want to talk a little bit to maybe, the volatility and the sort of the middle road is where we still feel ourselves to be sitting?
Yeah, and I think it's around that, and we've seen it in recent months that that macro volatility plays out when markets are quite reactive to any news, up or down, and the number of times the equity markets have gone up or down in opposite directions over a period of time is quite it's quite interesting to see all that play out, and just how reactive the markets are to any sort of those news events. So I think it's that whole commentary around inflation and interest rates staying high for longer and inflation being a bit stickier, that certainly seems to have what has played out. And now it's a case of, okay, well, inflation's now starting to come down, and hopefully it starts to get back to that target level.
It's amazing how quickly too the narrative shifts as well, right? Because and maybe only last month or the month before, where the genuine mood of the day was that inflation's high for longer was kind of the interest rates being high for longer was the theme that was really emerging out and causing equity market volatility. Yeah. And you fast forward a couple of months, and then all of a sudden, inflation looks a little bit healthier, and equity markets are still volatile. But it's amazing how we've gone from literally two months ago, from interest rates staying much higher for longer to, some kind of bringing the cutting cycle forward a little bit.
Yeah.
So I think, and we'll talk a bit to, our investment philosophy towards the end of the chart. But I think if anything, now more than ever shows that making decisions on data per month is almost impossible, right?
That's right. Yeah, and as these charts show here, the recovery in bond markets or bond returns from last month to this month over a 6 month period, plays to that very point.
Yes,
you just got to stick to your strategy, ride it out, and the long term plan is what's important.
Yeah, I think particularly in bonds. I mean, investors, as we talked about specifically in November about bonds, and investors are well within their right to be a little bit sort of jaded by bonds, because I think 2022 was the worst year for bonds in the last century. So when you're sort of hearing data of that kind, it's a bit frustrating.
Yeah.
But certainly, the rate cycle plateauing and now forecasting potentially cuts, has the inverse impact with bond valuations, and we're seeing that come back in return. So
that's right.
I think if anything, probably a good time to sort of sit on our bond exposure as compared to dumping it out.
Absolutely.
As you wouldn't be blamed for doing it, but it's probably the wrong time to be doing that.
And then with the equity markets over the last year, the dark blue line there being the Australian index, and the yellow line being the US, and the aqua being the global index. So what you can see there is why diversification is really important. Because if you're just fully exposed in the Australian equity, you've missed out on the reasonable outcomes that have played out globally in the US in particular. But again, it's all about not taking getting too carried away with what's happening in the short term. The Australian share market's kind of just bounced around a little bit over that last 12 months for pretty much a neutral position compared to 12 months ago.
Yeah, and I think it sort of highlights, homegrown bias doesn't always help us out here, right? And particularly in regard to, we talked at the start of this presentation about the mortgage rates in Australia relative to interest rates and the impact of the households have, and I think our share market in Australia is so bank and resource dominated, and I think it probably talks a little bit to the disparity in returns in equity markets over that time.
Yeah, that's right.
So a little bit further about equity markets there, but yeah, we're sort of seeing, volatility is still real, and I don't think it goes away either in the short term. No. I think the volatility in equities is here to stay, and I suppose if anything, what we look for as triggers are the news that comes out that is actually going to help businesses grow and make more money. Because at the end of the day, I mean, the thing that always fascinates about volatility in share markets is that sometimes the volatility has got no correlation to the performance of a business.
Yeah.
And, really, once we see the volatility dissipate from those macro events and we start seeing share markets, dare I say, be more reflective of the valuations of the companies in which we're pricing every day, we need to see some news that kind of supports the macro stuff kind of settling down a little bit. And, of course, businesses being able to be assessed on their ability to make a profit.
Oh, that's right. And this is a pure economic fundamental play, really. It talks to the share markets are made up of companies that have been around for a long, long time and will continue to be around for a long, long time. So yes, there'll be companies that have periods of poor business performance and outcomes, and that'll get felt through their that'll be reflected in their share price. But again, that's why diversification is really important. So if you've got a broader spread of investments, you can tolerate, a couple of bad apples in that portfolio.
And I think also too, you think about, we talked a lot today about interest rates and the outlook for interest rates, but seemingly we've still got these significant geopolitical risks of the world, and we're still seeing Gaza in turmoil and Ukraine still in turmoil. So these factors still have influence on the way we feel and kind of assess the world, and certainly still impacting equity markets. And maybe the half glass full of me always says, I like to see these things just disappear because it's the right thing for humankind.
Yes, but
they're going to be there for a little bit longer, which will continue to attribute to volatility.
Yeah, and as history will point to, there's always something going on every now and then, and that plays out in the market and talks to some of these movements here around. There's periods of downturn, but over a long period of time, clearly the upside has outperformed those periods of downturn.
Yeah, I think you made a great call out before, Andrew. I think it's particularly relevant in regards to this slide now is that, sticking to your strategy sometimes feels like it's the wrong thing to do. But, your point before was so spot on in that, if you've got confidence that your asset allocation is okay, you look at the historical data, you look at the news of the day and then think, well, should I change that given what's happening? And really, when we take emotion out of that decision making, then more often than not, the answer is no, I shouldn't change it, and let's just work our way through each and every step as things present. But sometimes human intervention and personal, you're seeing your hard earned, particularly if you, and this is probably more for unadvised clients, but working away and you're seeing your hard earned fall, and every time you flick the news on, it's all doom and gloom, and you start to panic and you can react. And that's the worst possible thing you can do. Yeah. I think you're spot on it, because emotion drives our decision making, but it's not until you look at things like this chart here that kind of allow you to take a step back and think, okay, through all those periods of history, there have been events that have been significant in nature, and we're not downplaying the significance of today, but certainly, in time, I'm sure we'll look back and reflect on it and think, okay, it was a difficult time, but the world, kind of worked its way through it, and we're all, kind of okay.
That's right. Yeah.
Do you have to, in wrapping up a little bit here, we have to give a little bit of a disclaimer here, Andrew, that today's advice or discussion is general in nature, which simply means that anything specific to your affairs that we will talk with you offline, or if it's someone you need to reach out to your advisor, and we'll have a chat with you. But if everyone's got here today, it'd be nice if they were still listening right now. But
that's right.
But more so, it's Christmas time, Andrew. What's your Christmas look like this year?
Yeah, look, I think just time with family and friends, and it's a great time to do that. Have a nice break. We're obviously off for 2 weeks during that period. It's just a great time to reflect and have some downtime and enjoy. And no doubt a date at the MCG also beckons, I think, Boxing Day. So not sure what Pakistan will bring to Australia, but that's always a good day. So I look forward to that.
Yeah, it's safe to say we're some cricketing nerds and tragics in our office, so I'm sure we're all venturing there at some point along the way. But more so, to everyone listening, we wish you all the very best for Christmas and a safe New Year, and we look forward to seeing you again in 2024 and helping navigate what comes our way.
Yeah, Merry Christmas, everyone.
Okay, bye for now.
Bye.